Good morning, everyone. I see some people have been dropping some comments already, but we opened up the comments there. So feel free to drop a comment there in the chat as you jump on. Hope everyone is having a great week so far. Today, kind of in theme with what we've been doing a little bit this week, is going to take it back to some basic stuff. Earlier this week, we are taking it back to, conventional and some DSCR, and we're going to do some back to the basic stuff here today as well with the FHA loans. So we're just going to wait a few minutes to get started like we always do so we can get live on all the platforms and give everybody a chance to tune in, and then we'll get started. Definitely an exciting time to see where the rates are going, and they're moving up and down from all the different stuff going on in the market and in the news. So it'll be interesting to see what the rates are today. They have been changing lately. Good morning, everyone there in the chat. Good morning. Good morning. Good morning, Christina, Kelly, Amanda. All right. Hello, everyone. Okay, so it looks like we are live on all the different platforms, so we can go ahead and get it started here. What we'll do is we will go ahead and take off the chat, and we will get things going here. All right. So, welcome everyone. My name is Kyle Hiersche. I am the COO of the Mortgage Calculator, joined here by Nick Hiersche and Jose Gonzalez. We are a correspondent lender that specializes in non-QM. But today we're going to be talking about something that's not non-QM. We're going to be talking about FHA loans. So, what we do here on this show every day is go through the actual live mortgage rates for today. So, we're going to pull up live rates with our pricing tool and go through the different rates for conventional as well as FHA and some of our non-QM products. But today's deep dive is going to be into FHA loans, as I said earlier, kind of going back to some of the basics. So we will do a deep dive into FHA loans, and Jose will pull up some quotes and do a deep dive there into the FHA products. So before that, let's go ahead and do what we do every single day, which is get into the live rates. So Nick will go ahead and pull up our pricing tool, and we'll check out the live rates for today and see where they're at compared to yesterday.
All right, so lots of activity this week, so we always love to check out the rates. Let me go ahead and switch my screen and pull up our tool. So as Kyle mentioned, this is our pricing tool for our team of mortgage professionals. If you'd like a full loan estimate with all the detailed breakdown, especially like Jose is going to show you here in a minute, please get with our team. We have over 300 licensed loan officers in pretty much every state, and we can do loans for primary and second homes in 22 states. And for our business purpose DSCR that we love to do as well, we can do those in pretty much every state. So a lot of great options there if you want a full breakdown, but we're going to use this tool to check out the general rates for today. It is March 15th, just after 11 a.m. As I mentioned, a lot of economic activity, a lot of news. A couple banks just got shut down, a whole bunch of stuff going on in the markets. So hopefully that equates into some positive news for us today. But let's check out our basic scenarios like we do every morning. We're going to set up a basic scenario of an 80% loan to value, 20% down payment loan. Nice, easy 400,000 loan amount. We're going to tell the computer to look for a desired price of 99. That means we're going to look for the best rate at one discount point in cost. Most of our buyers are requesting to buy down the rate a little bit there, so that's typically our request. And then we're going to go through our examples today. Conforming conventional will be our first example. Then we'll go into our FHA rates for a general indication. And of course, Jose will go into a deep dive later. And then we have our expanded guidelines, non-QM programs. where we have over 4,500 other programs using alternative income that we'll check out as well. We can also quote VA and USDA. VA is only for our eligible vets. We do appreciate your service and can quote you real quickly, but since not everybody's an eligible veteran, we won't do that live on the show. And same thing with USDA. We would love to quote those for you if you are shopping in a USDA eligible area, but not everybody is. Those are typically rural areas. So let's start our examples today with our conforming conventional. We're going to set purchase, 30-year fixed, standard scenario, primary, single family, 1 unit, state of Florida, county Miami-Dade, and for all of our estimates today, we'll use an estimated FICO score of 760 and an estimated DTI of 40. So let's check out our rates for this morning. So more good news. It looks like it went down just a touch or about the same. So a lot of this news has been good for rates. So this morning we have a 6.375 rate for 1 discount point in cost for an APR of 6.551. So some great options here for our conforming conventional options. And we love to see when the rates do go down. Remember, just last week we were up over into the 7s. So some great news for our buyers that are looking to purchase right now. Definitely recommend to lock it in while we're in this dip here. Now let's compare this to FHA programs, which was usually our second option. If for any reason a borrower doesn't qualify for conventional, we typically go to FHA as the next option. So we'll set the same scenario up, click over into FHA, everything else will stay the same, and we'll be able to compare our FHA rates this morning. So a couple options here. Looks like the best option the computer found, 5.625 rate for 1 discount point in cost and an APR of 6.227. So APR is lower than conventional. That doesn't often happen. But as I've been saying for the last few weeks, fortunately, FHA has had some announcements where the annual MIP mortgage insurance premium has gone down. So that's obviously fared better in the APR here. And FHA always typically has a little bit lower rates, but the upfront mortgage insurance and the annual mortgage insurance typically makes it a little more expensive. But now we see that compared apples to apples, when we look at APR, 6.227 is a little bit less than the best option we found on conventional, which was 6.5 something. So a lot of great options for FHA. Definitely recommend for those that are looking to purchase a home that FHA is a very valid option, especially with the recent improvements to the mortgage insurance. Now, if for any reason a customer cannot qualify for the home they want with either conforming, conventional, or FHA, typically a lot of banks or other lenders do not have any other options. But here at the Mortgage Calculator, we love to have other options. And under expanded guidelines, aka non-QM, we have over 4,500 loan programs that allow our borrowers who may not quite qualify using the full documentation methods of conforming, conventional, and FHA to use alternative income. So let's set up our last scenario for a primary home here. We'll keep everything else the same, but you'll notice a new option pops up now under non-QM, which allows us to change our income verification method. So full doc is 2 years tax return. So typically, if a customer doesn't qualify with 2 years tax return, conforming, or FHA, we're typically going to go to non-QM in order to use alternative income. So we typically don't choose full doc, but we can. We usually do some sort of alt doc, 1 year alt doc, 2 year alt doc. Asset related is a type of loan that we can do. We can do loans using business bank statements, very popular. For our investment properties, these DSCR loans are popular. And our most popular program for a primary home purchase is going to be a non-QM program using personal bank statements for 12 months. And that's going to be for our self-employed borrowers. Many times our self-employed borrowers, when they use 2 years tax return full doc, they often have write-offs and other things that create a challenge. So we're simply going to use 12 months of bank statements here to determine a debt-to-income ratio for that borrower. So typically, when we use our actual cash in the bank, actual bank statements, we're able to get a much higher income to use for our debt-to-income ratio, and therefore qualify our borrowers who would either otherwise not qualify at all or qualify them for more the home that they want to purchase. So a great option here under non-QM. Let's check out our rates this morning. Remember, these rates are going to be a little bit higher because these are specialty programs, but again, great options for borrowers who are stuck or otherwise need some other alternative. So the top program here that popped up looks like 7.375 rate for 1 discount point in cost for an APR of 7.422. So compared to conforming conventional, about 1 point higher there on the APR. So you can compare everything apples to apples. But again, these are for borrowers who would otherwise not qualify. So we love to present these options. If you qualify for conventional, great. We can quote that for you. We can also quote side by side with some of our non-QM options to give a little bit of perspective there. So we love to quote all of those programs for anybody that may need them. Now, before we go into a deep dive with Jose, we always want to do our last couple examples here for investment properties. So we're going to set up the same scenario, an 80 LTV, 20% down payment for an investment property purchase. And we're going to compare our two options. We're going to compare conventional investment property with our non-QM expanded guidelines options. FHA, VA, USDA, they're not eligible for investment properties, so it makes it simple. We just have two things to compare here. So first, we'll check out our conforming, keep everything else the same, and let's check out our conventional investment programs. All right, so looks like a decent option here. It's about the same as yesterday. I don't think this has changed too much. Just keep in mind, for these investment properties, there are additional low-level price adjustments. So unfortunately, we can't go higher in rate to lower the discount points typically. So even though some investors would not mind a higher rate, a lot of times we're kind of bound here by the highest rates we can get, which still have high discount points. So best option the computer found, 6.625 rate for an investment property with 3.625 in discount points, giving us an APR of 6.889. So a great option for our borrowers that do qualify. Obviously a great, nice low rate. These were well into the sevens the other day. Even if we go into the sevens, you'll notice we can't really lower the discount point. 7.49 here for 2.625, not that much better. Obviously the APR is much higher. So this is a better deal here overall and a great comparable there. But many times our investors want to save money out of pocket. So investors want what's our next best option. And that's where our non-QM programs come in. So for an investor with the same scenario, for an investment property, wants to use one of our non-QM programs in order to get less discount points out of pocket so they can use that money to buy other rental properties or whatever they need to do. We can use our expanded guidelines programs, and we can use our income verification. The most popular one for investment properties is going to be our investor DSCR, and that is because the debt service coverage ratio program does not actually require any income from the borrower or employment from the borrower. We're simply going to use the estimated rental income from the property that we're purchasing in order to determine if that estimated rental income can cover the housing expense, the PITIA of that mortgage, right? So it's just that mortgage, just that house. Don't have to worry about a whole bunch of other documentation. It is very nice and easy for our investors. And with our non-QM investment properties, we typically always have a prepayment penalty. So we can choose 0 if we'd like, but that will limit our loan programs. So we don't do that for our examples. 3 years is the most common, so we'll use that for our example today. And we can also choose 5 years if we want to save a little bit of money and hold a property for longer. But the most common option is 3 years. That's going to give us the largest amount of loan programs possible. So let's check out our DSCR options today. Wow. You see this, Jose? Wow. So yesterday we were at like 8.5, I think, on the show. So non-QM reacted a little bit later than the conventional markets. Remember, conventional markets are almost real time with stock markets, right? The FHA and the conventional rates will go up and down with stock markets. Non-QM, they typically adjust on a weekly, maybe a day later kind of basis. So you see here, all these adjustments didn't come in yesterday morning when we were hoping they would come in, but they came in today. So this is amazing, guys. Looks like our best option here, very comparable to those other options you saw. 7.75 rate for 0.85 in discount points for a final APR of 7.792. So great options for our investors that want to save discount points out of pocket and obviously use that money to invest in other rental properties. And this DSCR program is amazing because an investor that has multiple properties can cash out multiple properties to purchase multiple other properties and get multiple loans going at the same time. So DSCR, because it doesn't use any personal income or employment, doesn't get clogged up with those types of things. So you can really start and do multiple loans at the same time because they're more of a commercial business purpose loan. And we're just looking at the one property at a time, and we can do multiple. So these are great options. Obviously, you see here just tons of DSCR options that we have. The rates do vary. There's some other programs with higher rates. Those may allow short-term rental income and some other things, maybe foreclosures, things like that. So tons of options we have here that vary on the DSCR program. But the rates reacted amazing yesterday. We love to see that. So I'm glad we did the show today. Wish the topic today was DSCR, but FHA rates are amazing as well. So let me get into our deep dive with Jose. And
I think you said that backwards. Today is FHA loans. Yesterday was DSCR.
No, I said I wish today was DSCR so we could go through all those crazy changes. But FHA's had some great improvement as well. So Jose is going to go through some deep dive examples on FHA. As I mentioned, a lot of great, exciting news with the FHA programs. So we love to look at these. A lot of times they're more expensive than conventional. These last couple of weeks with them with FHA being less expensive, FHA is definitely more viable. So Jose, why don't you go ahead and go into a detailed example there and break it down for them.
All right. Good morning, everybody. Thank you for joining us for Daily Mortgage Rates Live with the Mortgage Calculator. Like Kyle mentioned, going back to basics here. But obviously, with all of the volatility going on in the market, it's always good to keep abreast, not just of the rates, but of all the different programs for a particular loan type. So what we're doing today is showing us a few different ways to look at FHA loans, right? We're all about outside the box here, different ways of looking at the same scenario to basically come up with solutions that other people don't see. So in our first option here that we have is for a 96.5% standard, quote unquote, FHA purchase. Now, with FHA, there are a lot of misconceptions about what FHA loans are for and who they really benefit. So they're not for people with bad credit, right? So let's get that out of the way. I mean, that's a big misconception in the market, and it does hinder sometimes FHA pre-approved borrowers being able to compete for listings, right? Because a lot of the listing agents have that preconceived notion that FHA loans are for people with bad credit, and that is simply not true. FHA loans just have different guidelines, different credit requirements, which are a little bit more lenient when the borrowers are at the lower end of the FICO score spectrum. Typically there are no adjustments to pricing with a 620 or above FICO score. Usually there's no issues with a 620 or above FICO score. In some cases, they may reduce the FICO score to 580 for automated underwriting, things like that, different overlays that the lenders and investors add, because FHA really does not have a minimum FICO score requirement. So whatever overlays the investors and lenders add are the FICO score that will be used for their program, right? So keep that in mind. There is no minimum FICO score. So, and how they're more lenient is, for example, mortgage insurance. On a conventional loan, mortgage insurance is charged based on credit score and LTV, right? So if you have a low credit score coupled with a high LTV, that's a recipe for a really high mortgage insurance rate. For example, 630 credit score borrower at a 95% loan to values, on a $350,000 loan could easily have, $450 a month premium. Whereas FHA, especially with the reduced MI premiums that we have now, is going to have a much lower premium because it's simply going to be based on a factor. And that mortgage insurance factor is only affected by the LTV at 95.01. It's one rate, 95.0 and below, it's a lower rate. So that's where we are, with the comparisons. Also with FHA, like I mentioned, if the score drops, let's say to 620, that's not going to affect the pricing on the rate. Whereas on a conventional loan, as the score drops, you will see loan level price adjustments. Usually on a conventional loan, anytime the score starts dropping below 740, there are loan level price adjustments that start kicking in. And as the score drops, those adjustments get higher. Right. So you'll see here also FHA tends to have lower rates than conventional. Right. It has to do with the fact that it's quote unquote, government insured, so to speak. So that adds a little bit more security to that product type, as opposed to the conventional loans that are the insurance is private. The mortgage insurance is private. On FHA, it's the government. So that's where that lower rate, extra level of security kicks in. So you can see here, if you remember the rates Nick was throwing out there for conventional, now you look here, FHA, we're looking at a lowest cost option of 6.125%, which is very low compared to what we've been hearing lately, and the lowest rate option of 5.375. So we're seeing some good movement there to the downside on the rates, which is very good. So this is your standard cookie cutter FHA that everybody knows about. But let me throw a couple things at you, which could help you. These are going to be niche type programs, but there are borrowers that are currently underserved that could benefit from these niche type programs. And the first one I'm going to mention here is one very dear to my heart, which is the Good Neighbor Next Door FHA purchase, 96.5% LTV. Now, this is a program, Good Neighbor Next Door sales incentive permits an owner-occupant borrower who is a full-time law enforcement.
Can you try to zoom in a little bit there, Jose? We can't really read the notes.
Man, I'm not.
Click the three dots, okay, and then at the top right.
I don't got them there, man. Let me.
The top right.
I got it right there. Let's zoom in a little bit.
Yeah, see if you can zoom in a tab, please. Much better. Yes,
you got it there.
I think we can read it now. Thank you, sir.
Okay, thank you. So Good Neighbor Next Door sales incentive permits an owner-occupant borrower who is a full-time law enforcement officer, teacher, firefighter, or emergency medical technician who meets HUD requirements to purchase a specifically designated HUD REO property, a HUD foreclosure, in a HUD designated revitalization area with FHA insured financing at a 50% discount from the purchase price. So mind you, maybe a little difficult to land the deal, but there are special controls in place here that would allow our officers and firefighters to benefit from this program. So when using this FHA insured financing, the borrower may purchase the HUD REO property with a minimum down payment of $100. It's real interesting there. 50% discount off the price, $100. And you're also talking about including reasonable closing costs in the mortgage also. So, and they even let you do repair escrows or 203K with this. So, I mean, this is really good option here. And you see the rates not as good as the straight out 96.5 option, but considering all the bells, whistles, and perks that this program has, these are great rates, right? So let's see again. I would believe that nurses like EMTs, because I just saw that question pop up there. I wanted to address it while we're on this topic. Probably do get because they're talking about emergency medical technicians,
That's
which are
that's EMT.
which
Yeah.
are EMTs, and then um, you're talking about firefighters and stuff. So I mean, I guess the question would be, nurses and doctors. I guess we could ask our AEs, but I'm pretty sure that they're going to fit into that group. So that's the $100 program, 50% discount. Uh, Now we have the regular $100 down program, if there's such a thing, which is a super cool. This is the same $100 down sales incentive that applies only when the borrower is purchasing a HUD foreclosure, or they call them HUD REO. And if they're obviously purchasing it with FHA financing. And if they are, then that purchase of the HUD foreclosure would qualify for the minimum $100 down option, right? And this one even allows you to throw in 203K if you need it, which is the rehab program, or a 203B with repair escrow. They do allow that on these HUD foreclosures to, incentivize the purchase. So here you're looking at still very good rate, 6.25 with a $1,203 lender credit, and you're able to buy it down all the way to 5.375. And again, this is a $482,000 loan, so that's just under 2 points on that one right there. So this is our $100 down option when you're purchasing a HUD foreclosure. So now we talk about one of the ones that is like a love-hate relationship, which is the FHA 203K. That's the renovation program. The only reason I'm joking around, I say love-hate relationship, only because you got to be very careful always in these renovation loans when you pick your contractor, because that's usually going to be the one obstacle here that may cause some issues getting the contractor to collaborate with all the necessary paperwork. But FHA 203K program, great program, allows for renovations to be completed on purchases or refinances, right? It is a great option for example, borrowers needing more space in their current residence, who prefer to stay in their current home rather than sell it and go out there and try to find another in this very competitive limited listing environment. It's also good for, and this is a real good purpose for it on the purchases, borrowers buying a home with condition issues that will not allow it to close via a traditional mortgage, property with code violations because they did unpermitted addition or repairs or whatever. There's no way you're going to close that one with a traditional loan. That would usually be cash only, unless you employ a renovation loan like the FHA 203K. And that could be a good opportunity to scoop up one of these properties that would normally be a cash only deal, but now you're coming in offering a finance price, which is going to be usually a little bit higher than the cash only price. And the buyer is going to be able to get a good deal on a property that they're going to be able to basically modify to their taste. Or it could be something where you're buying a property and you just want to update the kitchen and the bathrooms, and you don't want to pull the money out of your pocket because frankly, you may not have it after putting down the money for down payment and closing costs, and you really love the house. And it's, this is a great option, 203K, as long as your after repaired value covers the repairs, the cost and all that kind of stuff, the ARV that we're talking about here, then you should be good. Which is the difference when you do originate a 203K loan. The appraisal is different because it has to include the scope of the renovation, the as-is value, the scope of the renovation, and the after repaired value. That's how we confirm that you're not over improving the property. So again, 203K, great option. Now we have a down payment assistance option for FHA loans. And this is a great down payment assistance option because this one is a lender paid option. What does that mean? That means that it's a down payment assistance that is much more flexible than what's circulating out there, which is mostly a borrower paid option that will require then additional hoops of fire to be jumped through, because now you have to basically get seller contribution to pay for the uh, for the loan fees, as opposed to lender paid option where everything is included in the loan. Much better because it actually saves the borrower from having to either negotiate seller contribution, which seller contribution a lot of times if you get it, it just gets padded to the price. So now the buyer is going to have to risk possibly having to pay more for a property. Then you may have appraisal issues if you had to inflate the price to cover the seller contribution. What happens if it doesn't appraise? Now you're in a conundrum, catch 22. Is the seller gonna pay for it? Are they not gonna pay for it? Are they gonna cancel the deal? Is the realtor gonna have to pay for it? I mean, all sorts of things that can really mess up the deal. But that is not an issue with our down payment assistance option that we have here. That is a forgivable second mortgage. So the 3.5% of the sales price second mortgage is forgivable after 5 years if there are no 90-day lates on the loan. So very good option here. Yes, the rate is a little bit higher, obviously 7.875. There is a little bit of a cost there. It's like 0.3 something in points, but great option for essentially getting 100% financing and for getting that 3.5%, $17,500 forgiven after 5 years. True DPA, great option for anybody looking for that. And last but not least, this is one that was circulating a bit here in Florida where we're at, because we, I think, have had a hurricane recently. A couple of hurricanes come through in 2022, so there were some affected areas. So whenever we have that federally declared disaster zones, which happens every now and then, some flooding, heavy snowstorm, rainstorm, whatever it could be that they declare the area federal disaster area, then it could be possible to assist your borrower with one of these disaster relief options, right? Where actually the benefit of this option, I have it at 96.5, but the benefit of this loan is that I believe it lets you go up to 100% financing, basically circumventing the need for the down payment to allow the borrower who may be in a disaster. This is for borrowers that were affected, lost their homes. Now they're going to get another home. So that they don't add salt to the wound, they have this program for you so you can come in with no down payment on your FHA loan. So again, 6 really good options here, right? 1 traditional, and then we have our 5 outside the box FHA options here. Very quite a few options, and I would recommend that whenever you all get a chance to speak with your realtor partners out there, try to empower them a little bit regarding FHA loans, what they are, what they aren't, because a lot of times, it's a lot easier solution if the borrower clearly qualifies 110% FHA. What would be the issue there? Usually the only issue may be property condition that they may be a little bit concerned about. Should be the only stumbling block to keep a deal from being able to close FHA versus conventional. So looking forward to helping all of you set up some files, close some loans, some FHA deals, some renovations, one-time close, whatever it is, FHA, we can do it here at the Mortgage Calculator.
Thank you, sir. So Let's go ahead and wrap it up then. As Jose said, lots of options there. So as you can see, not only do we do all these non-QM loans, but even in the FHA world, there's multiple products that can be used in different strategies that you can take on. And so to do some of these loans, you really need a loan consultant that can consult you through the process of all the different options. So our loan officers at the Mortgage Calculator are trained in just that, to be able to give you the different options and consult you on your loan. Everything from conventional and FHA, like we talked about today, to those non-QM programs like bank statement, DSCR, all the way to fix and flip, ground up, land, every kind of loan out there, commercial. Our loan officers can walk you through that process. We have over 350 loan officers all across the country, licensed in 22 states for primary residences. And then those DSCR loans we talked about, we can do in almost every state. So you can visit us at themortgagecalculator.com for us to pair you up with one of our loan officers, or you can email us at info@themortgagecalculator.com. We do this show every single weekday at 11 a.m. Eastern, so we can see how the rates fluctuate day by day. And we do a deep dive every day, just like we did with the FHA loans today. So thank you, everyone, for tuning in. We appreciate it, and we hope to see you tomorrow at 11 a.m. Eastern. Take care. Have a great day.
Thanks, everybody.